Trading the January effect. The January effect refers to a recurring seasonal pattern in financial markets where stock prices, particularly small-cap stocks, tend to rise during the month of January. It has been discussed in academic research, trading desks, and retail investor circles for decades. Certain pressures push prices lower toward the end of the year, then those pressures ease when the calendar turns, allowing prices to rebound. The January effect is not a rule, but is a tendency observed over long periods, with many exceptions. Understanding where it comes from, why it appears strongest in certain stocks, and how traders attempt to trade it requires context, data, and realistic expectations. Just a quick reminder to please hit the like button and subscribe to the channel for more great content like this. Also, you can visit us on the web at investmentees.com and use the code BLOG to receive 20% off your next purchase. Early academic research in the mid-20th century noticed that January returns stood out compared to other months. Small companies showed especially strong performance. At first, this raised questions about market efficiency. If markets are fully efficient, predictable seasonal patterns should not persist. The persistence suggested that structural factors, not investor skill, were influencing prices. These factors were linked to tax rules, portfolio management practices, and human behavior. The January effect became a case study in how non-information forces can move markets. The January effect is one of the oldest documented seasonal patterns in equity markets. It suggests that average stock returns in January are higher than in other months. This pattern has been observed most clearly in U.S. markets, though similar effects have appeared in other regions at times. The effect has never been universal or guaranteed. What makes the January effect interesting is not that it works every year, but that it has appeared often enough to shape trader behavior. Tax loss selling is one of the most cited explanations for the January effect. Investors sell losing positions near the end of the year to realize capital losses and reduce tax liability. This selling pressure pushes prices lower in November and December. The effect is stronger in stocks with lower liquidity. Once the new year begins, that forced selling stops. Some investors repurchase the same stocks, while others reallocate capital to new positions. The removal of selling pressure alone can lift prices. When combined with renewed buying, the result can be a noticeable rebound in January. Not all stocks respond the same way to seasonal forces. Small-cap stocks have historically shown the strongest January effect. This is not accidental. It is tied to how these stocks trade and who owns them. Small-cap stocks tend to have lower trading volume. Fewer shares trade daily, and bid-ask spreads are often wider. When selling pressure increases, prices move faster. When that pressure disappears, prices can rebound just as quickly. Large-cap stocks absorb selling more easily. Their size and liquidity dampen the impact of seasonal flows. This difference explains why the January effect is often muted in major index components but stronger in smaller names. Institutional investors dominate large-cap stocks. They manage portfolios with longer horizons and stricter risk controls. Retail investors are more active in small-cap stocks. They are also more likely to engage in tax loss selling late in the year. This creates a cycle. Retail selling pushes prices down. January buying pushes prices up. The January effect is partly a reflection of who trades certain stocks and when they do it. The January effect is not folklore. It has been studied across decades of market data. That said, the strength of the effect has changed over time. Studies covering the 1920s through the 1980s found that January returns were significantly higher than other months. Small-cap stocks showed the largest gap. In some periods, a large portion of the annual return occurred in January alone. This concentration made the effect impossible to ignore. These findings were replicated across different datasets. They became part of finance textbooks and trading lore. However, patterns that become widely known tend to weaken. Since the 1990s, the January effect has become less consistent. Some years show strong January performance. Other years show nothing unusual. Changes in tax law, electronic trading, and global capital flows have altered market structure. Information moves faster in AMP, trades execute faster. The effect has not vanished, but it has become more fragile. It now appears in bursts rather than as a steady rule. This is the key question traders ask. If a pattern no longer exists, trading it blindly becomes dangerous. The answer is nuanced. The January effect exists, but not in its original form. Markets react faster to known patterns. When traders expect a January rally, some buy earlier. This shifts price movement into December or even November. The result is a weaker January signal. Professional traders monitor seasonal effects, but they rarely rely on them alone. Seasonality becomes a filter, not a trigger. Some of the January effect now appears before January begins. This is known as front-running. If enough traders expect a January bounce, they buy in advance. That buying lifts prices earlier. For traders, this means timing matters more than the calendar. Rigid rules tied only to January 1st are less effective than flexible approaches. Trading the January effect requires structure. It is not about buying random stocks and hoping for a rally. Successful attempts focus on selection, timing, and risk limits. Many traders look for weakness in late December. They focus on stocks that have underperformed during the year. The idea is to enter near the end of tax loss selling pressure. This often occurs in the final 2 weeks of December. Some traders wait for confirmation in early January. Others scale in before year-end. There is no single correct timing. Each approach balances risk and reward differently. Exits matter more than entries. Seasonal patterns can fail without warning. Many traders exit by mid-January or early February. They avoid holding positions once the seasonal window closes. Stop-loss rules are essential. A seasonal edge does not override risk management. Traders who treat the January effect as a probability, not a promise, last longer. January effect trading strategy example. This example shows how a trader might structure a January effect strategy using clear rules. It is not a recommendation. It is an illustration of process. The trader begins in early December. They screen for small cap stocks with declining prices over the past 6 to 12 months. They exclude companies with major negative news. The focus is on tax-driven selling, not fundamental collapse. Liquidity filters are applied. Stocks must trade enough volume to allow clean entries and exits. The final list may include 10 to 20 stocks. No single position dominates the portfolio. The trader enters positions gradually during the last 10 trading days of December. They avoid buying all at once. Each trade has a predefined stop-loss, often based on recent lows. Risk per trade is kept small. If prices rise in early January, partial profits are taken. Remaining positions are closed by the end of January. If prices fail to rise, stops limit damage. The strategy accepts losing years as part of the process. Some years show no January effect at all. Markets may fall despite seasonal expectations. Macro events can overwhelm seasonal patterns. Interest rates, recessions, and global shocks matter more. Traders who refuse to accept this reality often increase risk at the wrong time. Looking only at years where the effect worked creates false confidence. Ignoring losing years distorts expectations. Some traders tweak rules endlessly to fit past data. This reduces future reliability. A simple, robust approach performs better than a complex one tuned to history. The January effect is not the only seasonal pattern traders watch. It is part of a broader landscape. The Santa Claus rally refers to strength in late December and early January. It overlaps with the January effect but has different drivers. Holiday optimism and low volume play a role. The January effect focuses more on post-year-end flows. Understanding the difference helps avoid confusion. Seasonality reflects human behavior. Taxes, bonuses, reporting periods, and psychology shape markets. These forces change slowly. They do not disappear overnight. Seasonality should never be traded alone. It works best when aligned with trend, momentum, and risk control. Conclusion: the January effect is a historical tendency, not a law of markets. It has evolved as markets have evolved. For traders, its value lies in awareness. It highlights how calendar-driven behavior can influence prices. Profiting from it requires discipline, selection, and humility. The edge is small. The risks are real. When treated as one input among many, the January effect remains useful. When treated as a guarantee, it becomes dangerous. Understanding the difference is what separates informed traders from hopeful ones. Thank you for watching.